All right, live. Hey everyone, Jeff Bruno here from your outsourced CFO out in Philadelphia, coming to you live for acceleratoorg.com. And what a day! What a day, everyone. I am truly sorry for anybody who is involved or, who has any relations with what's happening over in Ukraine. I'm sure people are. Watching that as I was today a little bit on the news, and it's a sad state of affairs that we have to deal with that in our modern age in this world. It really, really is. So hopefully we can refocus our energies here on things that that we are as a group helping the world, because I view entrepreneurs and small business and what you are doing as helping the world. And we do that too. That's part of our culture. We try to help companies. We give the utmost value to these companies to help them grow. So hopefully that is what we could focus on today, even though things are crazy out there in the world. So I will jump in quickly here to some of these questions. I looked through them. They looked like there's some really good questions today regarding finance and operations and so on. Keep those coming. Here to help. So hopefully we get some West Coast people on today as well, being a little late on the East Coast here. So first submitter is Patrick Joseph, Pat Joseph Pigari. The question is, what are standard percentages of annual gross income for annual spend on legal, fees, marketing, and self-development? The business description is an e-commerce looking for barometer on how much should spend on legal, marketing, and self-development per year. All separate percentages or how to gauge spending. So, Patrick, I can speak to this, but again, I more context on these questions would be helpful. Anybody who sends these, please, as much context as you possibly can give on these questions. So, e-commerce business, legal, marketing, and self-development. Now, I'm not sure what you mean by self-development. You can mean two things. You can mean really like self-development, like yourself or your people, or you can mean business development. I'm going to go with the latter. I'm going to think you meant business development. So, and marketing. So what I would do is I would put business development and marketing in one tranche here, and then sort of legal and other professional fees. And I tend to like to lump things like this: accounting, legal, consulting. You could throw that into professional fees. Business development and marketing, that's another section that you would monitor. Now, percentage means absolutely nothing. And I hate to say that, because in your case, percentage is arbitrary. I get this question all the time from business owners, okay? All the time on this and across the board. What is my percentage that I should do, or my dollar amount I should do towards this, or that? And the reason I say it's irrelevant is it depends on the size of your business. If you're a $500 million business, 1% is a hell of a lot more than if you were a $100,000 business. So it's all relative. And in that, what you need to do is you have to sit, really, for you have to look at what is it that I need to do to build my business to the next level. That's really what you have to think about. So legal is going to probably be a high cost for a $500,000 business. And what I mean by high cost, it might cost you $10,000 in legal to set up things. Oh, that amount might sound like a lot in a $500,000 business, but in a $5 million business, that's nothing. Or a $3 million business, it's not that much. So it's all relative. What is good stuff on legal? Good costs on legal of a startup business, a business that has a few $100,000 in revenue? I can tell you that if you spend more than 5 to 10K, and this is just my estimates, but more than 5 to 10K on the things that you need for legal, like a good HR manual, a good subcontractor agreements, good operating docs, like an operating agreement, and so on, which are standard things that you need in the start of a business to use to facilitate the initial pieces of your business. If you spend more than 5 to 10K on that, you're spending way too much. So I would use that as a gauge. Marketing and development, much different. So marketing and development, there has to be an ROI or you have to look at a CAC, right? So I'll explain those two. ROI is return on investment. CAC is cost to acquire a client. CAC, C-A-C. Very important functions there. So if you're going to use marketing and development for client acquisition, then you want to know what that cost is. Example, I'm going to spend 15 grand on marketing and I'm going to get 4 clients that are going to make me 100,000 in sales. Now let's do easier numbers. 10,000 in marketing spend, 100,000 in sales. That's a 10-to-1 return, marketing to sales. But then you got to look at what the gross profit is on that. So let's assume the gross profit's about half that. So that's really a 5-to-1 return. ROI, because the rest is management. You get 100,000, you got 50,000, you spent 10. That's really a 5-to-1 return. Because you got to look at the gross profit construct on the return. Ultimately, you could look at the sales too as a marker, as a tracker, but that depends on how fluctuating your gross profit is, because those are the amounts of money that come to your bottom line. So, not your bottom line, but come to your fixed costs, come to pay you, come to pay your growth for your growth, all these other things. Sorry, I'm being a little circuitous here, but the point is you got to look for what that ROI is and what the cost is to acquire a client. So your ROI would be 10-to-1. Your cost is, well, that's 100,000 is 5 clients. So your cost is 2,000 per client. $10,000 spend, 2,000 per client. Now you know. Okay, that's what I can do. And you got to stick with those parameters on growing your business. And see if you fall out of line with those. What's going on? Is my marketing not in the right areas? Do I need to change my marketing and get it back to another area so I can get those numbers in line? So those are good things to look at. Hope that was helpful. Next question is from Dan Bitter. Dan asks, we listed an IT developer as owning 3% of the company on our Chase business application, but I can't find any documentation of the equity split agreement. Does he legally own the 3%? Okay, so Dan, I read through the rest of this, rest of your commentary, which is long, so I'm going to not do it here, but I would have to say this is not a question for me. This is a legal question, and I would absolutely have an attorney help you with this. There was one part at the very end that made a little bit of sense where you said, is 3% worth this worry, considering the likely dilution from potential angel and VC investors? So I don't know your business construct, but I would say that to you is all that it matters. So if 3% is not a concern for you and it's going to cost you $10,000 in legal to figure this out and fight it potentially, then are you worried about the 3%? Now, when you were to get new investors in, either angel or others, you get them in, there will be a scenario where there is a they will probably do the due diligence to figure out what you need to do to erase that scenario or get rid of it or whatever it is. They'll help you with the due diligence on that and probably even some of the legal correspondence with that. So don't worry too much about that, is my opinion, if you can stomach that. Next question is from Brad Letchworth. Brad asks, how do I analyze the numbers when it comes to adding additional work trucks for the company and break-even time frame? Business background. How do I review upfront capital needs and ongoing costs against projected sales in order to review purchasing a second or third work truck for the company as I expand? Brad, I love this question. Love it, love it, love, love it. So this is really related to your operational effectiveness. So what I mean is, this is related to what a truck actually does. So, but you have to pull this all together. It's not about just the truck. It's about the labor associated with the truck, like the driver, the people that are on the truck. I would look at this as the whole component of what that is. So it's not about just the truck. It's about all of the pieces together. And you want to get a break even. So if you have a business that's heavily dependent on trucks, driving your product around or servicing things or whatever that is, like I don't know what business you're in here, but you want to see what that looks like. So let's assume there's a driver at $25 or $30 an hour. Drivers are very expensive these days. They're in high demand. Let's say there's a laborer at $15 to $20 an hour. And let's say that's what you need for one truck to be able to do the deliveries and whatever it is. Factor that into a weekly scenario. So, and then look at that. Do I have enough sales to support that? So for a weekly scenario, let's say the truck costs you, I don't know, $2,000 a month on a lease or a purchase, $2,000 a month, maybe $3,000 a month for a good truck. And then every month, if you're fully loaded the trucks with the person and the laborer, you're looking at maybe another, let's call it $7,000 a month. So that's $9,000 to $10,000 a month to cover that cost of that truck. So let's assume your product sells for, you can sell, if you sell $20,000 of product with a 50% contribution margin or gross margin, that covers your truck. So you need to have $20,000 in sales to cover a new truck at $10,000 run rate of the truck every month, or cost, the truck and the laborers. That's the way I would look at it. So when you know you're going to have $250,000 in new sales coming in the pipeline here, building up over the next year, buy a truck. Or you're getting close to that. You're like inching up towards that, and you think, all right, I could have part of that, and I'm going to need the truck, or I'm not going to be able to service that. As long as you get a third of that in confidently, or half of that in, you know that you're on the right track for it, and you just got to go for it. So that's the way I look at it. Look at the holistic piece, and then decide if you have enough of a pipeline that's building to support that. All right, next question is from Ricardo Delgado. Ricardo says, how do I analyze purchasing another business? I have an opportunity to purchase a barber school. They're asking $80K. Would it make sense to get a loan to buy this business? So, Ricardo, a lot of questions here. A lot. Sorry to be wide-eyed there, but a lot of questions. 80K doesn't sound like a big number to me, okay? But what are you getting for 80K? And so in analyzing it, you have to say, well, if I'm paying 80K now, I want to see return on that money. So typically, a investor, a lender, or somebody else would want to see that can be cash flowed over a 3-year period. Most likely. I mean, lenders might go 5 years, but I think on that small of a deal, they're gonna shorten the time frame and see that you want to cash flow that over 3 years. So a lender would probably come in and say, all right, pay us $110,000 back over 3 years, which is about, let's call it $35K a year, okay? And you have to be able to cash flow that. So they would want to see about $45,000 of profit every year to cover that debt, minimally. Because they also want you to have more profit to grow the business. So they're probably going to say, well, realistically, we want you to see 50 to 60K profit, but 45 will service the debt. So is this 80K purchase going to make you next year immediately 45K in profit? If it's not, it's not financeable. If it is, it's financeable, and I would argue it's a good deal for you. Because if you're making 45K in profit, you probably are going to make more than that, I would think, in years 2 and 3 by purchasing the business. So that's a win across the board. And so that's how I would look to analyze it. What are you getting for that, and does it generate profit for you? Not revenue, profit. Because the banks are going to look at the cash flow component of it, or whoever's lending you money is going to look at that. So that's what I would look at there. And also, if there are assets involved, you could look at some of the assets. So another way to do that, one more small thing here, Ricardo. If you're buying assets of a barbershop, then you would want to show to a lender or someone, hey, I'm buying these things that I don't have right now that help facilitate me doing this much more revenue, which turns into this much more profit over the next 2 years. So if it's an asset purchase of that 80K versus just having more business come through because whatever you're buying, that's also something you can show that you would have had to buy those assets otherwise to support the uptick in your business. And since they're assets, the bank's a little bit more lenient on that. They might say, okay, there's some value in those, so we need less cash flow from the business potentially in the beginning especially, and they'll give you a little more runway. So some areas to think about. So next is from Kristen Lander. She says, how can I track sales made through strategic partnerships with other businesses? I'm partnering with several like-minded businesses to cross-promote our services and our products to each other's audience. What's the best way to go about tracking these sales? What else should I be considering in this process? Okay. Well, I'm sure the sales guys, Kristen, could talk to you about best ways to track it. I mean, I would use a CRM system, or like a Pipedrive or a HubSpot or something like that, and just tag the sales that are from those partners. I mean, it's that simple. Do a spreadsheet even, if it's simple. Just track the sales. So that's it. And then if it's them, you're going to give them a commission or whatever. And it's pretty simple. So I think your question is later about how to structure that, but you want to think about volume plays with them and rewarding them for volume. So start at certain levels. What a lot of people will do with partnerships is they'll say, hey, if I bring you a certain amount of business, it's this volume. At this volume, I'll pay you this. And then as you tranche up, I'll pay you more because it's more additive to your growth and your business process. And it also incentivizes them to send you more business. You want to cap it in a year construct so that it's fresh, new every year. But that's one way to do it. And just track them individually. Next question is from Colin Jarvis Gome. Colin says, what are some good places to look for investment? VC lists, accelerators. What exactly should I prepare to show potential investors? A pitch deck or metrics? Business description. Paul Mate's app is an app that connects dog owners near each other, like Tinder. I've had some initial traction on news spots and 10,000 downloads in 4 months. I'm working hard on branding thanks to discussion with Sean, but need some guidance on funding and where to find it. So, Colin, I love this. I Tinder for dog owners. That's hilarious. Oh, man, I got to check that out. So, yes, I mean, you could be falling into something pretty funny here, Colin. You could be falling into a matchmaking thing using the dogs. Like, owners find each other because of their dogs, and then, oops, they get together. So I don't know if that was your intention, but I love the concept anyway. It's funny. So, yeah, I mean, it depends how early you are in the process and what your traction is on your metrics. So, VC, no. I mean, unless you have a model that has a market penetration idea, has clear road to revenue, and or has some user eyeball function that can be really, really, what's the word I'm looking for? Viral, and tag into an advertising revenue model or some other scenario quickly. Unless you can prove that, I think VCs is a hard angle to go. Now, I don't want to say no because I don't know enough about your what you're doing or the traction you've made. But VCs are usually the next level on a funding. They're usually Series A, you'll call it, which is after friends and family, after angel, and then there might be like a Series A. And typically in Series A's with VC funding, you've had several years, 2, 3, of traction. You see an exponential growth potentially, and you're just riding it, and you just need money to keep feeding the beast so that your users just keep going exponentially. So otherwise, you'd want to show some revenue metrics on how you get there. So I think your avenue is friends and family, and or maybe angels, but this might even be early for angels. But definitely friends and family, no question about it. Accelerators are good, but it depends on what you're trying to accomplish with an accelerator. Meaning accelerators might take 2 to 5% equity to get you in the program, and they can be helpful. But it depends on what you're trying to do. They can help you produce a pitch deck. They can help you look at your financials and pull together projection models and so on, which could be helpful to get you to friends and family or get you to angels ahead of VCs. So accelerators could be good for that, and connect you with some other strategics potentially that could help look at your model. So I think that's a good area to, if you need to build out more of your construct. Otherwise, friends and family and angels. There are a lot of angel groups nationally. I don't know any specifically off the top of my head. There's some here in Philadelphia area that I've dealt with frequently, and there are some tech scenarios that if you're heavy on the tech side, there's one in Philadelphia in particular called Ben Franklin Tech Partners that will match funding. So you can look for some matching funding with others. So if you get angel funding, they'll match. I don't know if you have that where you are in your region, but look for things like that. Typically, those are funded by larger organizations or cities and states sometimes. So hopefully that's helpful. And here's the follow-up by Kristen Lander on Fiercely Fueled. Is there a threshold for a percentage of revenue that we take home we should aim to stay within? As I scale my coaching company, I'm paying out 46% of my revenue to contractors and about 15% commission to partnerships with other businesses. This means I'm retaining as low as 39% revenue of the revenue with clients brought in our partnerships before expenses, which right now are fairly low, but doesn't leave much room for me to hire admin until I significantly increase my profits. Is this just a normal part of the process, or should I consider changing something as I continue to scale and bring on more contractors and partners? My prices are already at the high end of the industry, so raising them isn't a good solution. So, Kristen, in continuation here, this is a problem in the sense of that your prices are capped, meaning you have no elasticity in your pricing. So it's okay, but that is going to limit your ability to scale. So your 15% on partnerships. I like the partnership model a lot. Okay, I like it a lot. But I mentioned this earlier in this live, and I'll say it again in a different way. I think that you should look at two things on the partnership model. You should look at a volume scaling piece that I was talking about earlier. So lower percentages for less deals they bring you in a certain year, and it builds up on that. And I also would not give them a percentage of sales at 15%. So I think that's too high. Maybe you go, I think 15% is going to just, if you're trying to just grow a base of business and offer a lot of your percentage of your revenue, to do that, that's different. But if you're trying to sustain a profitable model, 15% on the top line on sales when you're already giving away 40%, 46% to your contractors is too high. So you might want to look at like 7 to 10%, or you can go as high as 15 to 20% if you're doing it on gross profit. or contribution margin. So essentially, if you're doing it on that 54% that you're bringing in, then you can go, all right, I can give you as high as 20%. So it looks good, but it's really only about 10% of commission on sales. 15 is a lot. So keep that in mind. And it is going to limit. So you say, so in that model, you're only getting about 39% to your bottom line. In a consulting model or a coaching model, you really need to target, you try to get to about 55 to 65% GP or higher, because of that factor, because you have to give so much away to the quote unquote experts that you're bringing on your team, especially if they're 1099s. If you can bring them in house, you might have a little more flexibility there. But if you're offering a premium product and you're in coaching, you have to hit a 60 to 65% GP level. Otherwise, you're going to struggle to grow. You're just not going to have enough working capital. So think about all those things as you're continuing to grow. Or do the 15% until you hit a certain level and then readjust and say, look, guys, I'm bigger now. So, sorry, but we're ratcheting this down. You could always do that to try to get to a growth level where then you need to bring on more fixed costs to keep growing. So, that's the thought. Next question, Michael Wilding. Michael says, what would I need to put in place to help prevent infringement on my intellectual property from a competitor on the market? I own a ticketing platform for selling event tickets. I'm looking to get my website reprogrammed with a new programming language. So, Michael, this is absolutely an attorney question. You should look. I know a great IP attorney if you need them, and you need to be careful that you have your IP covered. Very careful these days. So, because I even was looking at this the other day on patents for something unrelated, actually in the crypto space, but I was looking at patents, and if you don't have your patent, provisional patent, or at least your initial filing of when you're going for something like a patent, for example, anybody who comes in and just files, they don't even have the patent, but they just file, then they beat you to it. And you are no longer held that IP. So, but then you're on the clock, so to speak, to prove out the patent process and then officially get the patent. So that's also, high stakes, because then you need to be ready to prove that out. So it's tricky with IP, but I would definitely consult an attorney, especially if you have something that's unique and really, really, really could have potential there. Get early with an attorney to guard that IP. And congrats on having it. It's incredible. So sorry I couldn't be more effective there. But that's all the questions. Great stuff, guys. Along business operation and finance, I love it. And please keep them coming. That's all I got for today. I am closing down here on the East Coast. Stay safe, everyone, and see you next time.